What if I told you there's a simple way to take money out of your S-Corp without paying employment taxes? And what if your biggest tax savings were hiding in plain sight in something called distributions? You want to see this if you're an S-Corp owner or thinking about becoming one. Hi everyone, Stephen Lee here. Here's the hard truth. 99% of S-Corp owners don't understand distributions, and it's costing them thousands in unnecessary taxes every single year. I'm going to expose the secret that your accountant should have explained, but probably didn't. So if you want to stick with me to the very end, I'm going to break down exactly how S-Corp distributions work and how to use them legally to keep more of your money in your pocket. I've been studying S-Corp structures for years, and there's one thing that blows my mind. Most people elect S-Corp status for the tax savings, but then they never properly implement the distribution strategy that creates those savings. This is going to change the way you think about taking money out of your S-Corp. So let me break it down step by step. Step number one, what are distributions? An S-Corp distribution is simply your share of the company's profits that gets passed through to you as an owner. Here's what makes distributions so powerful. Unlike your salary, distributions are not subject to employment taxes. No Social Security tax, no Medicare, no unemployment tax. They're only subject to income tax. So let's imagine this scenario. You're an S-Corp that makes $100,000 in profit. You take a $60,000 reasonable salary and $40,000 in distributions. You're saving about $6,000 in employment taxes on that $40,000 of distributions alone. But here's where most people get confused, and this confusion is costing them money. Are you a business owner tired of stressing over taxes? Starting this October, join my one-on-one Business Owner Bootcamp, where you'll get 5 personalized sessions designed to create your own strategic tax plan. And I'll show you how to accurately calculate quarterly estimated taxes, maximize deductions, and even determine an IRS-proof reasonable compensation for your business. Spots are limited, so click the link below to apply for your personalized spot today. Part 2, the reasonable salary requirement. Here's the catch that nobody talks about. Before you take any distributions, the IRS requires you to pay yourself a reasonable salary first. And this is where 99% of people go wrong. What's reasonable? It's what you'd pay someone else with your experience to do your job. If you're a marketing consultant making $150,000, you can't pay yourself a $20,000 salary and then take the remaining $130,000 in distributions. The IRS will come knocking. You want to make sure to find that sweet spot where your salary is reasonable enough to avoid IRS scrutiny, but low enough to maximize your distribution savings. Most accountants play it too safe here. They'll tell you to take 60% salary, 40% distributions, when you could probably do 50-50 or even less. And this is where the art of reasonable compensation comes into play. You'll want to refer to one of my previous videos where I talk all about reasonable compensation. Click on the information card on this video where I go much deeper into reasonable compensation. Part 3, how distributions actually work. Here's how distributions actually work in practice. And this is where it gets really simple. Let's say you're an S-Corp and you have $80,000 in profit after you're paying yourself reasonable salary. That $80,000 automatically flows to your personal tax return. Whether you take it out of the company or not, you're going to pay income tax on it regardless. That's the thing. A lot of business owners ask me that question. If I keep the money in the business account, will I be taxed on it? Yes. As an S-Corp owner, you are considered a flow-through entity. So anything that is profit or loss will flow to your personal tax return. You'll be taxed on it regardless if you keep the money in the bank or not. But here's the beautiful part. You can take that money out of your business account anytime you want with 0 additional tax consequences. It's already been taxed at the personal level. Most people think they need to do something complicated, but that's wrong. You transfer the money from your business account to your personal account. Just make sure your bookkeeper records it as a distribution, not additional salary. Part 4, the distribution tax rate secret. Here's what most people don't understand about the distribution tax rate, and this is huge. Your distributions are taxed at your regular income tax rate, but avoid the 15.3% employment tax. So if you're in the 22% tax bracket, your distributions are taxed at 22%, while your salary pays an additional 15.3% in employment taxes. That's 15.3% savings on every distribution dollar. So for example, on $50,000 in distribution, that's $7,650 back in your pocket every single year. And here's the kicker. If you qualify for the QBI deduction, that's an additional 20% qualified business income deduction. Your effective tax rate on distributions could be lower in this example to almost 17%. We're talking about a massive tax savings here. And in the video description below, I've prepared a complete breakdown of how to calculate your estimated tax in a downloadable worksheet. Check out that resource in the description. So don't let the IRS surprise you. Take control of your taxes today. Part 5, common distribution mistakes. Let's share the biggest mistakes I see S-Corp owners make. Mistake number 1, taking distributions without paying reasonable salary. First, the IRS can reclassify your distributions as wages and hit you with back taxes and penalties. Mistake number 2, not tracking distributions properly. Your distributions reduce your basis in the company. If you take more distributions than your basis, you could trigger capital gains tax. Mistake number 3, multiple owners not following the ownership percentages. If you own, let's say 60% of the company, you get 60% of the distributions, period. With an S corporation, it's much more stringent in regards to distributions based on ownership percentage versus, let's say, a partnership or an LLC, where there's a lot more flexibility in what your ownership percentages can be different from what you take home from profits. And these mistakes can cost you thousands, but they're completely avoidable with proper planning. Part 6, the cash flow strategy. Here's a pro tip that most accountants never share. You don't have to wait until the end of the year to take a distribution. If your S-Corp is profitable, you can estimate your annual distribution and take them monthly throughout the year. This gives you better cash flow and helps with personal financial planning. You want to refer to one of my previous videos on how to invest, because you definitely want to beat inflation rather than just leaving the money in a savings account. Just make sure you're conservative with your estimate. If you take more distributions than the company actually earns, you'll have to pay some back or face tax consequences. The wealthy understand this cash flow strategy and use it to their advantage. Now it's your turn. Understanding distributions isn't just about saving for taxes, it's about optimizing your entire S-Corp strategy. If you're currently taking everything as salary, you're leaving thousands on the table. If you're taking distributions without paying a proper salary, you're risking an IRS audit. Here's what you need to do this week. Review your current salary to distributions ratio with your CPA. Make sure you're in that sweet spot where you're compliant but optimized. And if your accountant can't explain distributions clearly or seems overly conservative, it might be time for a second opinion. And it might be time for you to sign up for the private one-on-one bootcamp starting this October. And if this video cleared up some of the confusion around S-Corp distributions, you definitely want to subscribe to the channel because I'm continuously breaking down tax strategies that could save you thousands of dollars. And in closing, S-Corp distributions are one of the most powerful tax-saving tools available to business owners, but only if you understand how to use them properly. You now have the knowledge that most S-Corp owners never get. The question is, what are you going to do with this information? Thank you for watching, and I'll see you in the next video where I'll break down more advanced strategies for business owners to help you save even more. Until next time, bye.